Today, we're digging into overseas realty. And let me tell you, there's a story hiding in plain sight right inside their financial statements. So on the surface, you see this number everywhere, a headline profit of 6.47 billion rupees for the first 9 months. It's a huge number, right? It's the one that grabs all the headlines. But here's the thing, that number, it's not just misleading. It's actually hiding the real story of the company's incredible operational strength. All right, before we dive deep into these numbers, just a quick heads up. This is purely fundamental analysis for educational purposes. It is not financial advice. Okay, so to uncover that hidden story, our first stop is the income statement, the P&L. We're going to deconstruct it. So that big headline number, turns out it's pumped up by a 2.33 billion rupee non-cash gain, something totally unrelated to their main business. Now, once you pull that out, you get the real core operating profit, 4.14 billion. But here's the kicker. It's not just that the number is smaller. It's that this core profit, the actual engine of the business, grew by an absolutely incredible 92.9%.
So how on earth did they pull that off? Well, check out this operational efficiency. Their revenue shot up by a massive 63.4%, but their costs? They only went up by 26.5%. Think about that for a second. When your revenue is growing more than twice as fast as your costs, you're looking at some seriously powerful, sustainable margin expansion. Now that is real business strength.
But hey, any good analyst knows you can't trust just one statement. It can be misleading. So to really verify this explosive growth story, we've got to cross-check it. We need to look at all three key financial statements. And this brings us to a concept that every single analyst needs to master. I call it the three-statement lie detector. It's how you can tell, for sure, if the performance a company is reporting is actually real or just smoke and mirrors. Okay, let's put it to the test with their apartment sales. Step 1, the claim. The P&L, the income statement, is claiming a massive 112.5% growth in sales. Big claim. Step 2, the proof. We jump over to the balance sheet, what they own and what they owe. And what do we see? Inventory is down by 755 million rupees. That backs up the story. And step 3, the money. We follow the money to the cash flow statement. And there it is, a perfect match. A cash inflow of 755 million. See? The story connects. It's real. But wait a second. A sharp analyst might look at this and see a red flag. The operating cash flow is 2.55 billion. But the profit was 6.47 billion. That cash number looks kind of low, doesn't it? Is the company actually struggling to collect the cash it's earning? Wrong. This is not a red flag at all. What we're actually looking at is a massive financing move in disguise. There's a 4.06 billion rupee debt repayment hiding right there in the operating cash flow. It's making the company's cash generation look way, way weaker than it actually is. And this, right here, brings us to the company's real power play. They are using all this incredible cash flow for something really smart. They're not just growing, they're aggressively paying down debt, what we call deleveraging, and basically making their financial foundation rock solid. And it all starts right here. They generated so much cash from their actual business that they were able to pay down a staggering 3.5 billion rupees in related party debt. Just gone. And what happens immediately when you wipe out that much debt? Well, their interest costs, they just plummeted, down by nearly 40%. That is a huge recurring expense just vanishing from their books. Now, this is the really crucial part. This isn't just a one-time win. When you slash interest costs like that, you are directly and permanently boosting your future profitability. Every single rupee they're no longer paying in interest, it drops straight to the bottom line, every single quarter. And what this does is it kicks off this incredibly powerful virtuous cycle, right? Higher profits generate even more cash. That cash can then be used to pay down more debt, which then boosts profits even further. You see, it becomes this amazing self-reinforcing loop of financial strength. And this chart right here, it shows you the results of that beautiful cycle. The company's debt-to-equity ratio, a really key measure of financial risk, has been slashed from 0.28 all the way down to just 0.18. I mean, this is a company that's making itself financially bulletproof. Okay, so let's zoom out for a second. Let's step back from overseas realty and talk about the universal framework here, the lessons that you can apply to any company you're analyzing. So, what are the big takeaways from all this? How can you use this exact method to spot hidden strength in other companies? All right, here it is, the framework in 3 simple steps. Number 1, always look behind the headline profit. Strip out those non-cash items to find the real operational earnings. Number 2, use the 3-statement lie detector. Make sure the story from the P&L, the balance sheet, and the cash flow statement all line up. And number 3, spot hidden earnings power. Look for companies that are aggressively paying down debt and kicking off that virtuous profit cycle we just talked about. So, here's the final verdict. The headlines are going to say something simple, like overseas Realty posts soaring profit growth. And yeah, they'll be focusing on that shiny surface-level number. But what the real numbers show, what you now know how to find, is something much more powerful. A cash-backed, deleveraging, sustainable growth engine. 2 completely different stories. And that leaves us with one final thought for you to take away. Which companies in your portfolio are strengthening their foundation right now, in plain sight, just waiting for someone like you to do a deeper analysis and uncover the real story?